Welcome to Waypoint Real Talk, where we discuss real estate and your home. Let's get started with your hosts, Aaron Shishilla and Austin Heinz.
Waypoint Real Talk. My name is Aaron, and with me I have...
My name is Austin, and with us we have Chance from VanDyk Mortgage.
How's it going, guys?
It's going great. Thank you for joining us.
Absolutely. No, thanks for having me here. Can I just say something real quickly? That beginning intro?
Sure.
Yeah, I'm going to date myself here right now, but did you ever watch that old SNL skit with Mike Myers? It was Sprockets. No?
No.
Oh, God. For all the listeners out there, it's just like they had this part of Sprockets where he's like... this is the part of Sprockets when we all dance. And then like the music cues and everyone just kind of sits there and dances, And I was like,
yeah, we should do that.
Yeah, kind of, it was just it was a moment.
Left shoulder, right shoulder.
Yep. We have to choreograph.
Yeah.
Future guests, we're choreographing our intros.
Also, before we get started, I want to talk about an elephant in the room because I've been receiving hate, and it's about our green screen. I'm sorry about the green screen. We are going to remove it. I'm not using it, so it shouldn't be there. I get the point. Okay.
We're moving on.
We're good?
Done.
We're good.
All right.
Now to talk about myths with mortgage, right? Mortgage myths.
Yeah.
So you get this a lot to where people believe certain aspects of purchasing a home and getting money. When we talked, you dialed it down to like 5 typical myths with mortgage lending. Number 1 being, I need to put 20% down. So why is that a myth? And isn't there like PMI involved? And I'm sure we're going to get into that. So can you tell me why that first one's a myth?
Yeah, well, I when we use the term myth on that particular one, I always like to kind of maybe say it was an old thing of the past, right? But I think nowadays it's definitely a myth where people are in that mindset of, I don't think I can do this. I get a lot of people that come up to me and are like, I don't have the 20% down. I don't think I can purchase this home. It's a lot. It's a big stretch for me, and it's really at that point just taking them, slowing them down, and being like, "Listen, that whole 20% mindset is a thing of the past, and it is because of the PMI, right?
Right.
Now, don't get me wrong. There are people that want to put 20% down to maybe do something like principal reduction to drive a payment at a certain point. Cool, that I understand. But when we're talking about needing to put 20% down to get rid of mortgage insurance? No.
So then how do they get rid of mortgage insurance if they don't put 20% down?
Right. So, when we're looking at the loan programs that are available for a borrower to take on, right, it depends a lot on the situation, on their situation rather. So if it's a veteran, they're going to use a VA. Naturally, part of that program, the beauty of it rather, which is why I love veterans, I'm one myself, there's no mortgage insurance on that, right?
Okay.
So they don't have to pay that. They don't have to worry about that. FHA, a whole different story there. Unfortunately, you have to pay mortgage insurance through the entire life of the loan, no matter how much you put down, right? But on conventional, all right, let's talk about conventional for a second here. And the mortgage insurance that's on there, it's the reason that the 20% was a thing back in the day was to obviously put the lenders to take relief from them of there not being enough equity in the home should the borrower default, right?
Okay.
So, and now you have mortgage insurance that's introduced to that. And that essentially is going to help the borrower purchase a home without having to put the 20% down. But naturally, people are going to go to monthly mortgage insurance, right, on a conventional loan. I think that's just the habit of people get into that. I'll just pay for it monthly until it drops off at some point. Right, and usually, typically, that's about 78% of the loan to value. Okay. But there's little tricks that you can work around to get rid of mortgage insurance other ways. So when I'm talking with people about this, if they want to put 20% down, say, well, let's hold off. Let's maybe do 5% down. Okay. You can buy out your mortgage insurance actually at closing. You can pay for it all up front.
Okay.
You can get rid of it that way. And it's beautiful. It's great. It's an excellent program. It's what we call single premium MI. Okay. And at that point, what they're doing is they're paying for their entire mortgage insurance premium. You can either pay for it in cash or you can finance it into the loan. So you don't need that 20% to get rid of that.
Oh. So it's like, you don't pay 20%, and then they say like, okay, well then the typical thing would be your PMI's $200 a month. And instead, I'm just going to pay it all outright at closing.
Correct.
For the 5 years or whatever it is until you pay.
Yeah. So usually, on average, they'll say about 7 to 9 years or so if you're going to pay for it on a monthly level, depending on how much you put down, right? And that will at that point drop off, right? So again, we bring it to that 78%.
Yeah.
But yeah, and so it's a great program. And when you bring that to people's attention, you see the light bulb go off, and it's like, holy cow, really? Like, I can do that? And yeah, absolutely. So now the cost of the premium is obviously going to vary because just like an interest rate, there's a lot of variables that go into calculating how much that costs. But naturally, at the end of the day, it is an option to bypass mortgage insurance without having to do that 20% down.
Gotcha. Okay. So now our next one, which you mentioned, is people think they need to have good credit in order to get a loan. So, and what's considered good credit? What do you think is the minimum for what people need?
So, when we bring it back to loan programs again, because they, the guidelines that are applicable for them vary. So and then they, mind you too, they also vary upon the lender. Okay. Right? Because it's the guidelines of the investors that they have to adhere to some extent. So if they're, if especially right now with COVID, you're seeing credit restrictions coming, are more common these days, right? Where FHA, before you can go down to, some lenders were doing 600 or 580, right? Now a lot of them are restricting that and saying, we need you to have a 640. So. But
still, that's a lot different than having a good credit score. I mean, you could still get something.
Yeah. So, and the thing with that is everyone's like, I don't have an 800 credit score. I can't do it. No, you can. Yeah, you can still, hear that, people? You don't have to have an 800 credit score. You could still buy a home. Crazy concept.
An 800 credit score is like super hard to get, isn't it?
If you have an 800 credit score, I just want to shake your hand.
Not right now.
Yeah, not right now.
5.
Exactly. Yeah. It'll be the elbow. What do they call it? The COVID bump?
Yep.
Right?
COVID bump?
Yeah.
I didn't know that was a thing.
Yeah, it was like an elbow bump like that. So still maintaining some
sound and everything?
Yep.
Yeah, you do. You got to knock that in there. But, so yeah, I mean, when we're looking at conventional, traditionally it's a 640 minimum.
Okay.
And then, depending on, there are some programs for like down payment assistance, things of that sort. They want you to have a minimum credit score for that as well too. So, but again, when we're talking about mid sixes, you could still, you still have the ability to purchase. There's just things that what we want to look at besides the score that's important, right? How's your credit strength? Like, do you have long history of trade lines? Is there foreclosures on there? Is there bankruptcies, collections, things like that, right? Multiple, what we call like rolling 30s or rolling 60s. If you have these on there, well, now we got to start trying to get a little creative here. You know what I mean? So, but yeah, at the end of the day, now you don't need an 800 credit score. So
nice. I can go in with a 640.
Yeah. Nice. Do you get pre-qualified?
Huh?
I know a good lender.
Did I get pre-qualified? That's something I didn't know too, which I think we'll talk about later, is like that's one of the first steps is to get pre-qualified.
Yeah. So. Yeah. It's probably the most important one.
Yeah. Okay. So if you don't have money to put a down payment in, and you have that 640 credit score, 680, whatever it is that you're going, people think, okay, I need down payment assistance. Why don't they need down payment assistance?
Well, it's, I like to say that down payment assistance is like a last ditch effort.
Wash your hands just for a moment.
Oh, sorry.
You're good.
I get the Italian comes out of me and I start directing air traffic over here. So
you're not doing this.
Yeah, it's not yet.
Not yet.
The next topic, it's going to bring it out.
You could do this. Yeah. This is fine.
The bubba da boopy. All right. But yeah,
I'm going to quote that.
Yeah, can we quote that?
Boopy?
The Baba da Boopy?
Yeah.
We're going to clip it.
Yeah.
Okay, that sounds good.
It was on a Family Guy, actually.
Was it?
Yeah. Oh my God, it was a great episode too. Yeah, Peter Griffin had this mustache. He goes into a deli and he's like, "I speak Italian." He's talking to the deli guy. He's like, "Baba da Boopy, biba da bapa." It's so good.
Sounds good to me.
I'm more cultured now.
So yeah, as far as down payment assistance goes, again, it's a program and it's an option that's available for someone should they need it, right? Do I say it's the worst thing on the planet? No, it's obviously there to serve a purpose, and it does serve a very good purpose. And we do work with a lot of programs that help people with that. But what you really want to look at is when you're doing down payment assistance, depending on the entity that's providing that assistance, a lot of times that comes with, more fees, right? Because now you're introducing another element into the equation, right?
Right.
So you have another party that is part of this process. So there's obviously going to be fees that tie into that, right? A lot of times too, you're taking on an interest rate that is being, for lack of a better word, mandated from that same, organization. So if you're doing something state related, city, county, whatever it may be, a lot of times they're going to post an interest rate and say, "Hey, this is the rate that you have to take."
Okay.
Most of the time, and I've said most of the time, there are times where sometimes the rate may be very good and competitive to still go with it, but most of the time they're going to be higher than what the industry average is.
So if you don't have enough money, then what do you do if you're not getting down payment assistance?
Yeah. So the avenue that I try to take with my clients when we're looking at how to creatively structure this when it comes to challenges like maybe not having enough cash in hand, we'll look at things like maybe seller concessions, and I know for all the realtors out there that are listening right now, they're probably cringing like, "Oh,
What's a seller's concession?"
So a seller's concession is where the seller provides some cash to go towards closing. Right? It's a contribution. Yeah. So,
Gotcha.
Where, and again, being in the market that we are in, it can be a challenge sometimes, but it is an option now, right? So it's something to think about, and it doesn't have all of these other, things tied to it, like extra fees or a higher interest rate or the need of you having to pay that back, right? Some of these down payment assistance programs, you have to pay them back. So not only are you essentially borrowing this money for down payment assistance, but now you're paying a higher interest rate because of it. You're paying more fees.
Can't you just, maybe I'm confused here, because can't you just take out the mortgage loan amount that you need? And I guess down payment assistance is so you don't have to take PMI, because maybe I'm confusing the two.
Yeah. So when you look at the breakdown, right, you have like your down payment, right? Whatever it's 3.5%, 5%, whatever it is, you have your down payment, you have closing costs, right? And then you have things like prepaids, which is money that goes towards escrow, right? So when you have all this bundled up that is in your final cash to close figure, the down payment assistance helps out with that.
Okay.
Right. So it's less of a financial burden for the borrower to take on by saying like, I need $15,000 in closing costs and prepaids and down payment. Well, I only have $7,000. So that is supposed to help alleviate a little bit of that for the borrower.
Gotcha.
But if you can get creative with it, sometimes you can do gifts. Right. Gifts are an acceptable form. Pizza. God, you know what? Right now, pizza and tacos are probably more valuable than the money that's in the mint.
And toilet paper.
Oh, toilet paper.
Germex.
Man, Germex. If someone showed up to closing with, a pallet of toilet paper, can you imagine? Like, you could probably buy, Tom Brady's mansion over.
I think we're kind of getting, I think that's a little stretch.
A little bit of a stretch. Okay, maybe not so much Tom Brady. Sorry, Tom. Yeah, but
yeah.
But but again, the ways to work around out the gifts, family members, relatives, things like that. So
those kind of gifts.
Those kind of gifts, exactly. Not to like, hey, I heard you needed some brown sugar.
Yeah.
Here's a gift basket.
Yeah, here's a gift basket.
Yep.
Congratulations. No, we're talking about some green here.
Okay.
So yeah, you can do gifts. You can do things like that. So.
Gotcha.
again, it's going over those options with people and discussing those, and it's consulting with them on it, right? Because let's kind of, I keep on whacking the table here. I'm sorry. So it's the Italian coming out. When you have, let's just use as an example of $7,500 as down payment assistance, right? Well, after these extra fees get tacked on, if you really want to look at how much you're getting, I'm making up numbers here, okay? So for everyone that's listening, don't hold me to the fire on this, okay? But if you're receiving $7,500 in down payment assistance, well, let's say you have an increase in fees of $1,500. Well, now you're really only getting about $6,000 in down payment assistance.
Gotcha.
You know what I mean?
Right.
So yeah, you're still getting an amount, but maybe not as much as what you originally thought you were getting. Mm-hmm. So again, when you're consulting with your lender, it's a matter of having that conversation about them with that. So
back into myth 4. Myth 4. So myth 4 is it's cheaper to rent than to buy. And I think this might be the case because people think, I need to put in a down payment. I need to put maintenance on the home and everything else. Mm-hmm. Why is it not cheaper to rent than to buy?
So this is like, oh man, this question or this debate comes up all the time. It's like cats versus dogs. Which one do you like better? I asked this question on Facebook the other week, and the amount of responses I got back was amazing on asking how much people pay on rent.
Yeah.
Right? And you'd be surprised on some of these numbers that people are coming back with. I took all those numbers.
Can you tell me?
Yeah,
what are they?
Yeah.
What are they?
So some people were paying $1,800, $2,200 a month in rent. I mean, it was ridiculous. I was like, wow.
For what size of a space, though?
I mean, we're talking, a lot of them didn't get into specifics, but okay. I would venture to think maybe three bedroom or 2 bedroom or something like that. But then you start looking at locations. I'm seeing a lot of am I making the right choice here right now?
It's fine.
Everything's fine.
Everything's fine.
Yep.
Moving on. Why?
Next topic.
Yeah.
We'll talk to you after.
Yeah.
But yeah, no. So I took all those though, and I calculated it. Right, there's probably about 150 people that chimed in on it. And I took all that and I averaged it out. It was about $1,500 a month.
Okay.
Right. So between everyone, now think about it: $1,500 mortgage payment, I can get you into a pretty good size mortgage. But the important part of that is when you look at setting yourself up in an equitable position with a tangible asset, right? That is when the analysis that I did was a 9-year analysis on it. Rent jumps up every year.
Yeah.
Right? So I think we all can agree on that. Mm-hmm. Well, your mortgage payment stays the same. Mm-hmm. The only thing that might change on it is the variables would be your taxes and insurance. Mm-hmm. Right? But ultimately, your mortgage payment stays the same. 9 years, you're making the same mortgage payment you made 9 years before. Right? Well, if we take 9 years of a rent payment, and when I did $1,500 on the 9th year, it was $2,200. After all the increase.
Okay, what were you increasing by?
So it was the rate I went off of the average in the Tampa Bay area, which I think was 4.9%.
4.9%. Mm-hmm. Dang.
Mm-hmm. Yeah, on a rent increase every year, on average about 4.9%.
Wow.
So it was holy cow. I mean, you're throwing money out the window. Forgive me, you're not throwing it out the window. You're putting it in someone else's pocket.
Yeah.
Yeah. I mean, I don't know about you guys, but I kind of like to maybe put the money back into my own pocket if I could. So when you look at the rent versus buy and you start going over amortization on the loan, right, which is essentially bringing down that principal balance, and then you take the increase in value of the home or the appreciation, right? That difference there, I mean, is could be tens of hundreds of $1,000s that you're essentially throwing out the window.
And it's usually a break off point, right? So it's maybe 2 years of renting isn't so bad. Mm-hmm. But if you're going to live in one place for, like you mentioned, 9 years, over 7 years, then you start seeing the drastic changes in the amount of money, right?
Yeah, well, I mean, if you're looking at the rate of increase, on the rent payment, You know,
Okay.
so but like when I did the analysis on it, essentially like on the first year, yeah, it was almost like kind of neck and neck. You know, it's like $1,500 on the rent, $1,500 on the mortgage. You know, about that, right? And then to your point, yeah, as you start creeping up on the years, then it really starts hitting you a little bit harder.
Right.
You know, so now here's the deal: there's nothing wrong with renting. You know, I mean, depending on your job, maybe your lifestyle, whatever it may be.
Maybe you work for a home inspection company.
We'll leave that out. Yeah. Judgment-free zone. But yeah, I mean, again, it's not to knock people on that, but I just hate seeing people, you know, like just do something like that, like throw the money out the window. You know, it's like, come on. I think homeownership is a privilege that everyone should have, you know, at some point in their life, whether it's earlier on or later on. There's no shame in that. I mean, I qualified a friend of mine yesterday. He's breaking 40. He's buying his first home. He's like, man, I feel like I'm so late in the game. I'm like, don't feel that at all, brother. You know?
I'm sure there's a lot of people that don't even buy a home.
Oh yeah, there really is. There's people who do not buy at all. And again, you know, it's all depending on what their situation is like. So, but at the end of the day, renting is going to cost you more at the, you know, in the long run. So,
Right. Okay. So now the last one is, which I think we mentioned at the beginning, is like if I'm looking for a house or looking to buy a house, before I go speak to a lender, I need to go find the house.
Yeah. So this is happened so often.
Does it really?
Oh my God. So many people are like, you know, they jump on Zillow, they jump on Realtor.com, they find the place. Oh my God, I got to go check this out. You know, and then next thing you know, they find it, and then they go to like, you know, put this offer in, and I mean, granted, that's if the offer even gets accepted without being pre-approved, and then come and find out, like once you're under contract, maybe you didn't. You know, maybe something came up.
Right.
You know, well, guess what? Now you just potentially wasted money and time and, you know, unnecessary stress.
I think we did a previous podcast where we had another agent come in here. It was Danielle, and she speaked about how you could start 3 years before you look at a house to start fixing your credit, so that way you save so much more money in the long run once you actually apply for the loan.
Yeah. So if you want to take that mindset, and that's the right approach, I wouldn't go 3 years out, but the emphasis to that point, which I agree with, is setting yourself up properly, right? When you're getting pre-approved, turn the stones over now. Find out what it is maybe you might need to work on, where your strengths are, where your weaknesses are, right? And in that way, when you get to that time when you're like, all right, now I'm ready, well, now you set yourself up for a beautiful, you know, position. Because again, when we talk about trying to make things work under stress can get a little intense, right? And maybe the experience doesn't come off as good. And essentially what we want to do is, being people in this position as a real estate agent, as a lender, we obviously think about the client first, right? And their experience and everything else. They're, you know, everything from before closing to post closing, you know. So if someone didn't do their due diligence to qualify that person properly, yeah, you're really setting yourself up for some, you know, potential fires to put out and everything else. So it's important to not put the cart before the horse.
Right.
You know, and if someone, you know, we talk about the 640 credit score or whatever it may be. Well, you know, what if their credit score, if they had time to build that up from a 640 to a 700 or 720 or that unicorn of an 800 credit score? I know you're out there. I mean, you're putting them in a better position, right? They'll get a better choice on a rate, things like that, you know. So it'll cost them less money if they put in the time to do things properly.
Yeah.
So
that makes a lot of sense.
Oh, absolutely. Yeah. You know, so, and I think it's just right. I think it's just the right thing to do. You know, I mean, I don't know about everyone that's listening or watching right now, but if I'm going to get ready to make the largest purchase of my life, I kind of like to do my homework on it first and make sure I'm like, okay, am I in a good spot to do this?
Yeah.
You know?
And as we all know, some people aren't I guess I'm really, really planned, and so is Austin. He'll put a chart
Every podcast we've done so far, Aaron's somehow managed to work in mentioning a spreadsheet
It's
that I'm
my
going to be putting
goal.
together. Yep.
Austin loves spreadsheets.
I do. I used to hate them, and then I got a real appreciation for them.
And then when he goes to look at apartments, he'll spreadsheet the whole thing by
did.
amenity and every
Location.
breakdown.
Yep.
Location, highway
Specials
access,
going on.
specials.
Yep.
So are you going
If
to
they gave him a free drink when he...
Hey, that free drink.
That actually happened with one of the apartments we toured.
Really?
They gave us a free hard cider.
A
at the
hard
beginning.
cider.
Yep.
Yeah. Well, we got offers from many, but...
Yeah. I mean, talk about closing. You
Right.
know? I mean, I would have closed on the spot there. You
No,
give me
we
an
walked
old
away.
fashioned.
Yeah, we didn't choose them.
No.
But
Yeah.
that's okay.
Probably a good idea.
But it wasn't a White Claw.
Yeah.
Ooh, man, yeah. So, but when you go to purchase, then are you going to do the same thing? Break out the spreadsheet,
Probably.
yeah,
And I'll expect a White Claw.
and you'll expect, yeah,
Yep.
yeah.
I've already started that.
Okay, okay, all right, beautiful.
Yeah.
I love it. I love it. I mean, you and forgive me for not being so savvy on Excel, but I remember back in the day and using. I'm like back in the day when I used Excel. Yeah, I mean, we could tie the graphs on with the information on there. Do you have like all the pie charts and all that stuff on there too?
I haven't gotten that fancy with it yet.
Ooh. Oh, all right.
I'm sorry.
All right.
I'll step it up for next time.
Well, I was going to say, for the apartment part of it, that's cool. When you start getting into house shopping,
I need to up my
let's
game.
see some pie graphs.
Okay.
Yeah.
The pie graphs
Yep.
idea.
We're all visual
Yeah.
people here.
Yeah.
You know?
What's the special table to where you can like manipulate it to? Like if-then statements? Should throw those in there.
Should I?
Yep.
Okay. If my credit score is this, then
Yeah,
this
then-
happens. If this,
If they give me a White Claw, then...
yep, exactly.
Yep.
Yep.
Oh man, I love it. I'm going to start doing spreadsheets when I get home now. You guys
you should.
inspired me. Thank you.
Good.
You're welcome.
Yeah.
Yeah.
Yep. Just shout out to Waypoint Inspection when you do it, though.
Yep.
I will. I'm going to go live on it, Facebook
Yeah,
Live.
perfect.
I'm going to be like, Waypoint Inspection. You guys woke up this passion inside of me. I didn't know it was there. Spreadsheets.
Nice.
Yeah.
We'll start a private Facebook page. Spreadsheet enthusiasts.
Yeah.
Yep.
So, Chance, where can people find you if they have questions?
Yeah. So, carrier pigeons is a good way. I'm learning to read smoke signals right now. I haven't been really too good at that though. It's a little windy, so.
That's understandable.
Yeah.
I purchased the book from Amazon.
Oh, did you?
Yeah.
Okay. All right, cool. So can I borrow that from you when you're done? No?
It's expensive.
Okay. All right.
Sorry, man. Gotta afford to buy a house.
okay.
Need that 800 credit score.
So a good way to reach me, honestly, is like the old school way. My cell phone is best. When it comes down to that, it's the quickest accessibility I have. So I'll go ahead and throw it out there for you all. And watch. I'm probably at like the 1 or 2 o'clock in the morning phone calls or text messages.
Probably.
Yep.
Yeah, I always put my foot in my mouth after I do this. But here you go, everyone. So it's 360-929-4052.
And I'll also put it like down below. So it'll be there.
It'll be there.
It'll be there.
But another way to check me out on social media, obviously, is going to be a great way. I put a lot of fantastic content out on my page. And it's, you get to see the colorful side of me as well, too, if you guys aren't bearing witness to this now. But look me up on Facebook, Chance Unger. You could scope out my business page as well, too, Chance Unger at VanDyk Mortgage. VanDyk is VANDYK. Scratch the E. That E always finds its way in there somehow.
No E.
Yeah, no E.
Well, appreciate it, Chance. Thank you so much for making the way out and covering this with us. We really appreciate it.
Yeah.
And I guess we'll talk until next time, man. I'm sure we got tons more ideas coming.
Oh, absolutely. Thanks for the opportunity. I really appreciate it as well, gentlemen. So that means a lot. And the next time we're going to do the Sprockets dance, though.
Yes.
Yeah,
All right.
yeah.
All right.
We can
Whoa.
outro to that.
We
can-
We'll do
all
that.
right.
We got that. It is kind of like the shoulder,
Oh.
boom, boom. That type of
Oh,
thing.
I was doing it wrong. Okay.
Okay.
Thank you, everyone. Until next time.